In general, we want the media to be full of good news and our lives to be nice and enjoyable. But if we want the results that we want to get with a good life, strong economy, good housing markets, sometimes we must treat the bad news as good news. Now, if you're not sure what I'm on about, please watch this week's Property Insider Chat as Dr. Andrew Wilson and I explain some of the latest data and what it means for our housing markets. Now, if you want to keep up to date with what's happening to the economy and property, please subscribe to this YouTube channel and click the little bell icon so we can let you know each time a new show comes out. We're living in unusual times. In normal times, no one really questions good news about the economy. Yet currently, when most of us want no further interest rate rises and we want inflation and interest rates to fall over time, bad news in the economy is more likely to give us the results we want. Now, over the last week, we've received the latest news about the labour markets, home building costs and home loans. To understand whether these results were good or bad and their implications for the property market, I'm looking forward to my weekly chat with Australia's leading housing economist, Dr. Andrew Wilson, Chief Economist of My Housing Market. Hi, Andrew.
Yeah, good day, Michael. And you're so right that usually higher interest rates, while they're bad news for consumers, are actually good news in relation to the big picture on the economy, whereas lower interest rates, whereas they're good news for consumers because you're paying less on your mortgage, it actually means that the economy perhaps is struggling. So there's a lot of hysteria around about the direction of interest rates, particularly in the US. But we've got to take that all with a grain of salt because a lot of that is margin chasing. Those that are trying to talk up the prospects of lower interest rates in the US are doing it because they feel that might give the stock market a lift. And plus, people take positions, and that means they gamble, they bet against the likely position of interest rates. So there's always a margin involved there. A lot of the recent chat about the imminent cut in interest rates in the US is now starting to look, as the data comes through, of course, a little bit weak, and predictions of a March cut in the US are now certainly drifting away. At one stage, the US markets, whatever that is, the interest rate market, was predicting a 100% chance of a March cut in interest rates in the US. That's down to around about 60% at the moment. But I would have thought that if you're predicting 100% that something's going to happen, Michael, then it should happen. You know, it's not as though you're saying it's 99% that we're going to see an interest rate cut in March. And then you can say, when it doesn't happen, you can say, oh, well, that was that 1%. But when you say it's 100%, it's 100%. So it just shows you the nonsense that comes out of the financial media, really. And it really does reflect the fact that a lot of this is positioning and a lot of it's designed for people to gamble on the outlook.
Well, let's look at Australian figures then. The latest unemployment figures remain steady at 3.9%. But Andrew, if we dig deeper into the statistics, there are a few stories to tell.
Yes, there are, Michael, and we're really seeing an uptick in the trend, which is probably no surprise. We've been tracking at those record level 3.5% over most of last year, despite 13 increases in interest rates since May 2022. We've had this remarkable run of record low unemployment rates. We have to go back to the early 70s to see similar numbers in the mid threes consistently. And we probably didn't see the consistency that we've had over the last 2 years or so in terms of those 3% unemployment rates. So it's a remarkable position that we've found ourselves in. Our labour market is extraordinarily strong. Of course, it's the same in the US and similar in the Eurozone. We are starting to see the impacts, I think, particularly of strong migration on the data, and still very low at 3.9%, Michael. But we've got to understand that we've had the best part of 500,000 people coming into Australia over the last 12 months. They have to find work, even if they're students, they look for part-time work perhaps. So it's been remarkable that up until now, really, we haven't seen any significant change in the labour market data. So let's have a look at the latest data, the December jobless rate. And of course, the unemployment rate is the first data set that we get for December, for the end of the year. The rest will follow on the other ABS data sets. But the jobless rate remains at 3.9%. The number of jobs, however, fell by 65,000. But we have had a remarkable growth in jobs, Michael, as you know, over the middle and latter parts of 2023. So a little bit of adjustment there. The data we know from the ABS has been slightly questionable And a lot of that is because of the seasonal adjustment problems following the COVID lockdown period. But nonetheless, I think that there is an adjustment process there in terms of the falling job numbers following recent surges. Unemployment numbers were, however, lower, but we have seen the unemployment numbers rising over the end months of 2023, with the exception of November when they were up. Participation rate was down, which accounted for a little bit of that change in the unemployment rate, down by 0.4%, perhaps holding the unemployment rate at 3.9 because there were fewer people looking for work. But the participation rate was down by 0.4% to 66.8. But it does follow what was a previous month's record high. So I guess it's a little bit of an adjustment month, Michael, if I could say that, at the end of the year last year. Job numbers falling following significant rises and the number of unemployed falling. So a little bit of end of year catch up, I think, in terms of the data set. But nonetheless, I think the big picture is that we are starting to see the impact of high levels of migration on the underlying trend for the unemployment rate, which is now clearly tracking above where it was at the middle of last year.
Well, the Reserve Bank would be happy seeing these figures. It's wanting to get the unemployment rate up a bit so that we don't have a wages push.
Absolutely. And you're right, it's a good news number, even though it's a bad news number, because the easing in the labour market is important for the RBA. Fewer people with jobs means the less money's being circulated and people become perhaps a little bit more concerned about job security. So their spending patterns ease. Obviously, very early days here. This is, let's not quibble. This is a very, very strong labour market in a very, very strong economy, Michael. And these numbers again reinforce it. Although the trend, as you said, is moving in the direction which would make Reserve Bank feel a little bit more comfortable about the positioning of interest rates going forward. When we look at the state breakdowns, New South Wales had the lowest unemployment number over December. Its unemployment rate was at 3.4%, so well below the national result and well above really most of the other states. The nearest to them was South Australia and Western Australia at 3.8%. But I think it's interesting that most of the states are now reporting higher levels of unemployment compared to a year ago, Michael. So that's just sort of exception South Australia, which had a higher number a year ago than most of the other states. But I think that's just pointing to the easing in the very, very strong labour market. So it's sort of gone from nuclear just to extremely strong, I think, with the latest data.
Okay, when we look at other data that came out during the week, we got house building costs. And I know My Housing Market keeps an index of that. The surging house building costs sent a lot of builders broke, those who locked into fixed price contracts. It also had a significant impact on inflation. So what did the latest house building figures show, Andrew?
Well, the trend continues to improve, Michael. We've seen that, thankfully, over the last 6 months, even though building costs continue to rise, and they were higher over November, which is the latest data set that we have. And this data is derived from ABS numbers, but it is the My Housing Market Index. But yes, we saw the index rise again over November. So there's still some energy there in terms of rising building costs, which, as you said, is not good news for the industry. But the positives that we did get out was that when we look at the annual increase in house building costs, Michael, they have certainly started to trend downwards. The annual increase is now down to 7.1%. So the increase in the building cost index over the past year was 7.1%. Of course, that's well below the peak, its peak at 23.3%. Can you believe that? A year ago, it was 17.9, and now we're down to 7.1, and certainly trending downwards over the 3 months to November. So I think that's some good news in terms of the trend. There's no doubt that the levels still remain high, Michael. And when we look back to the pre-COVID annual house building cost increases, they're around about 2% on average. And that's what the building industry sort of needs to be consistently profitable, is those sort of increases. Now, at 7.1%, we're way ahead of 2%, but we are trending downwards, and let's hope that that trend continues to improve in terms of lower house building costs, because when we do look at the inflation, the basket of goods for housing has been a significant contributor to overall inflation, Michael. Not contributing as much as the oil price, but certainly being the second most robust measure of inflation, contributing to the CPI. And of course, the measures that the ABS use for their home costs, for their housing costs, are rent. And we know what's been happening with rent, and also house building costs. So they're the two components for house price or for housing prices. So some better news there. Again, following that better news from the RBA's perspective on the labour market, from also house building costs. But still some way to go, Michael. So we're not saying victory yet, but we're heading certainly in the right direction.
I just wanted to remind you that this is not specific investment advice because we don't know your personal circumstances, but we're more than happy to have a chat to help you take advantage of this new property cycle. If you think about it, the opportunity like this to get set at the beginning of a new property cycle doesn't happen very often. So why not have an obligation-free chat with my team at Metropole to discuss your goals and to discuss your options? We're much more than just another buyer's agent. We help you safely create intergenerational wealth through property. We're big enough to tip the scales in your favour, but still small enough to care. And as we don't sell any properties, our advice is independent and unbiased. Now remember, property investment's a process, it's not an event, so you can't just go out and buy any property and hope to be successful. In fact, now more than ever, getting the right advice is critical. So if you're looking to invest in property or buy a new home, go to metropole.com.au and have a chat with our multi-award winning team. It's a great feeling having the team at Metropole on your side, levelling the playing field. One of the areas I look at when I want to see what's going to happen to house prices moving forward is home loan approvals. Many people get their home loans pre-approved before they go out into the market. So we just recently had the home loan figures come through as well, Andrew.
Yes, Michael, no surprise that home lending has been rising. The trend's clearly been rising since the beginning of 2023. So we had the latest November numbers out for home lending. That showed an overall increase of just 0.1% over November compared to October, but an increase is an increase. The interesting scenario was that overall lending, or for owner-occupiers, total owner-occupiers up 1%. Investors, which have been doing quite well, really, Michael, over the past 6 months, up by 1.9%. But the big mover was first home buyers. First home buyer numbers were up by 12.4%. Now, the ABS pointed out that they've had problems with first home buyer data, that they didn't actually publish first home buyer data for a number of months. They revisited their models and they've now come out and they seem to be quite confident that what they're revealing now is what's actually happening in the marketplace. I guess in a way, to see that big rise in first home buyer numbers and the trend upwards is no surprise, because there's plenty of motivation out there for first home buyers, Michael, of course. There's a number of Commonwealth and state incentives for first home buyers. But of course, the disincentives are everywhere to be looked at. I mean, we have this terrible rental market, which makes it very tough for the first home buyer to save the deposit. It also is a clear disincentive to be in the rental market, not just the constraints to saving. Of course, generally inflation is still tracking at well above what we would call expected or normal levels. So that makes generally saving tough anyway. And last year we've seen the real killer for first home buyers, and that's a double figure increase in house prices, So house prices are on the rise. We've seen higher interest rates and high rents and high prices generally. So no surprise that first home buyers are really getting a move on in terms of getting into the housing market. Plenty of incentives to get in there, plenty of disincentives not to certainly be in the rental market. And maybe, as we've discussed before, we're also seeing the initiatives from the Bank of Mum and Dad also being a factor in those rising loan numbers. But having said all that, the numbers are still well below where they were a year ago, Michael. That's the point. Lending is still well down on the year to date and the full year comparisons.
Andrew, clearly people are starting to get a little bit of FOMO. First home owners, also investors. They were waiting for the property values. Some were waiting for the property values to fall, as some of the negative Nellies were telling them. Yet they see property values rising, even though it may be a little bit more slowly. They see their rents going up. So investors are recognising there's a window of opportunity before everyone else gets in. Home buyers are recognising that in many cases it's even cheaper first home buyers to pay the mortgage, especially if you've got the Bank of Mum and Dad on your side as well. So I can see those factors still being positive for 2024. Those who get in at this time of the year are going to look back at the end of the year and think, gee, it was pretty cheap back then.
That's right, Michael. I mean, it's a never-ending story, is it not? as you said, the investors are still reasonably active, have been consistently, and now we're seeing a surge in first home buyers. And maybe not a strong activity from owner occupiers generally, because a lot of that pent up demand has been satisfied. Those that did buy into the negative Nellies made their buying and selling decisions, albeit a little belated last year. They've done the job. Prices have increased as a result, of course, 10% plus in most capital cities. And now we're seeing a flattening because of that, the satisfaction of pent-up demand. And of course, there are also affordability issues with prices rising are starting to constrain new buyers coming into the marketplace. But that's the cycle and how it works.
Well, of course, these figures we've been discussing today are lagging figures. They're results from last year. And even though they've only just recently been reported, the Reserve Bank's going to meet in a couple of weeks' time and take into account those factors, but in particular, the CPI figure that's coming out right at the end of January. But we'll be back once a week to report what's happening in our housing markets. And as always, there's good and bad news, Andrew.
Yeah, but generally it's good news, Michael.
Well, it really depends. And I think that I've never come across a wealthy, happy pessimist. I think one has to be optimistic and recognize that even though there's always issues and concerns, we live in the best country in the world. We live in a great time in history, despite all the challenges, and the fundamentals are on our side. So I look forward to another good year in property, Andrew.
Absolutely, Michael. And we'll talk about it again next week.